In this episode, we discuss the importance of integrating insurance considerations into the due diligence process, especially during M&A transactions. We're talking to Kenneth White, or Kenny White, is SVP of the National Practice at Aligned Insurance Services. And I am Darshan Kulkarni, Principal Attorney at the Kulkarni Law Firm. I focus my attention on FDA-regulated companies and their service providers, including issues involving medical affairs, clinical research, and drug advertising. Let's get into it. So Kenny, the last time we had you on, we were really talking about the types of insurance policy coverages, and you named over 10 of them. When I do these types of due diligence analyses, rarely is insurance talked about in the way you're talking about it. Talk to me about the optimal way about how someone would pull a insurance company into the conversation to minimize their risk as they move forward, and or what are the alternatives? If you like this type of content, please like, subscribe, share. It really helps the channel.
The first thing that you have to do is identify a risk, quantify that risk, and then determine the best way of handling that risk, whether it's to operationalize it, put it on the balance sheet somewhere, whether you assign it off, don't buy that piece, have a escrow account to cover it, or buy insurance or some other alternative risk financing tool. Insurance is just a means to an end. It's a goal that a product that you can buy that covers a risk. It's not the only one. One of the reasons for that primarily is that in order for us to do our job as risk consultant is we have to have access to documentation, access to contracts. We have to have access to existing bonds or fronting arrangements or insurance policies. So the decision to buy, sell, et cetera, has usually already been made. There's a letter of intent. Then they bring us in along with accountants and everybody else to do our part of the due diligence. Let's say it's a medical practice. Obviously, first thing that pops into everybody's head is professional liability, medical malpractice. But you also have either ownership property or lessor property interests that you've got to cover. You have employment liability. You have fiduciary liability if you have any type of a health plan or retirement plan associated, how to move those over, what to do with it. Then you've got issues related to crime. You've got cyber. Depending upon business structure, you probably need D&O coverage. If you are using unowned autos, then particularly, nobody thinks about this, but home health, delivery of medications, all of that stuff. It's not just your employees getting from point A to point B. Sometimes it's not the insurance clause that really matters. It's the indemnification, and limitation of liability clauses in the contract that are much more important than the amount of insurance that a company carries, and particularly if that company is very large and has the assets to handle any given liability anyway. And then you work with a company's risk tolerance or risk appetite, how they like to handle their risk. Do they want to buy insurance? Do they want to put money aside in an escrow? Do they want to just keep it on the balance sheet and pay for it as they go? And then figure out the best way to finance the risk, because the risk is going to be there.
Should I be thinking about, we need an insurance lawyer to come in and basically go, here are the types of coverage. I now need to pour over the documents and start identifying and quantifying risk, because that's not a normal thing I have seen. Which scenarios are you seeing this more and more in?
I think we may be neck and neck with nuclear power, but if we're not the most regulated entity or industry in the country, we are, next to it. And of course, in today's world with global companies, you've got EU, you've got UK, you've got India, you've got China, you have other,
all the
issues, where risk is not onshore, it's offshore. So how do you deal with that? You don't want to buy a company thinking that it's $100 million company and then realize that it's only 50 because there's some latent liability out there that you're going to have to pay for that just sucked all the value out of the company that you just bought. And let's take your example, regulatory risk for pharma. We can identify it, but you don't know how to finance it unless you have a decent idea of what it can cost you.
Right.
So in terms of regulatory, you've got obviously the expenses associated with investigations. You've got potential defense costs if there's litigation arising out of it. You've got the potential for a D&O claim if it arises to something significant. You've got an E&O potential claim. You've got fines and penalties. You've got the very possibility with CMS or things like that you get blacklisted.
Makes sense. Thanks again, Kenny. For M&A due diligence assistance, email me at darshan